Stocks were never in history more expensive than now. At least this is what you can hear from every side nowadays, but how much is it actually true? Let's take a look. Okay, so first of all, when we will take a look on the S&P 500 through the PE ratio, what is basically one of the most popular metric to measure how expensive these stocks currently are, here we can see that currently we are sitting on the levels of the 28.6, what is not even as high as we were at the 2020 and definitely not as close as we were in the dot-com bubble or at the 2009 financial crisis. So at least as per the PE ratio, what is basically the price of the stocks divided by their earnings, the US stocks in the S&P 500 are currently not the most expensive in the history or not even since the dot-com bubble, even though the levels about the 28.6 are much higher than what is the long time average, what is around the levels of 17 to 20. When we will take a look on the forward PE ratio, what means price divided by the forward earnings, here we can see that we are at a quite low levels, as the earnings in the following quarters or years are expected to go much higher. So currently the forward PE ratio is at the level of the 23.10, while back in the 2021 it was at the level of 40, and at the top of the dot-com bubble we were at the level around 45. So when we will take a look on the valuation of the S&P 500 as true forward PE ratio, here we can see that we are even below the long-term average, which is at the level of 25.26. So as per this metric, the S&P 500 is definitely not the most expensive in the history as well. PE ratios and forward PE ratios are one thing, but it is also Shiller PE ratio. This price earnings ratio is based on the average inflation adjusted earnings from the previous 10 years, and it's also known as the cyclically adjusted PE ratio, aka CAPE ratio. And here we can see that now at the September of 2025 we are already at the higher levels than we were back in the November of 2021. Of course, we are not as high as we were at the top of the dot-com bubble, what was at the level of the 43.21, but at least as per this metric it's true that the S&P 500 stocks are currently the most expensive since the dot-com bubble. Even though there is still space to grow, last time we visited those levels and even the levels before, we saw quite a big decline in the price. So let's see what's coming after this. But as I said already, at least as per this metric, the stocks are now most expensive since the dot-com bubble. And when we will consider that the long time average is at the level of 17.2, we are currently sitting at the much highest level at the moment. So none of those are at the highest levels, even though the CAPE ratio come in close. So what are they talking about? Well, PE ratios of all kinds are not at the highest levels, but the PE ratios metric are not the only one you can take a look at. So let's take a look on another metric. This time it will be price to sales. Price to sales ratio is basically market cap divided by its revenue. Simply said, it's how many dollars investors are paying for each dollars of sales a company makes. And as we can see, we are currently at the highest levels since the dot-com bubble. Even though the peak at the dot-com bubble were at the level of the 3.4, we are currently sitting at the level of 3.2, what is not so far away. And as per this metric, just how they said, the stocks are currently the most expensive since the dot-com bubble. And at the same time, when we will consider that the long time average is at the level of the 1.2, or somewhere you can find that the average is 1.4, still the levels of the 3.2 are extremely high. A high price to sales ratio basically means that investors are betting the company can grow the sales massively or maintain super high profit margins. So even though we were almost at the same levels back in the 2000s, back then the companies didn't have the profits and were being valued on potential revenue that never came. In contrary, today's giants like Apple, Microsoft, Nvidia, Google actually do have profit. But if the price to sales is at the extremes, it usually means that the investors are assuming margins can stay unusually fat or that the sales keep compounding at crazy rates. But if the margins compress or the revenue growth slows, those valuations will not hold. When we are searching for the reason of the high price to sales ratio, one of them might be the current high concentration of the top 10 companies in the S&P 500, and also that big part of the S&P 500 is in the IT sector with the high profit margins. The 10 largest companies in the S&P 500 has currently almost 40% of its total value, what is highest number in the history. So when we take a look on the valuation of the S&P 500 through the optic of the price to sales ratio, yes, the stocks are the most expensive since the dot-com bubble at the current levels of around the 3.2, what of course may be a signal for risk, because when the price to sales ratio is at those high levels, the market has a very little margin for error, so even small disappointments on earnings or growth or whatever can cause a big price drops. Historically, the average of the price to sales ratio is between the 1.2 to 1.4, depends on the length of measured period, but the 3.2 is still much higher than the average. But as I mentioned already, it's mainly caused because of the high concentration of the big tech companies in the SP 500. For example, if all stocks in the SP 500 had the same weight, the price to sales ratio would be actually at the level of 1.76, what is a big difference in comparison with the current levels of 3.2. Also, even it might look like another bubble, the situation is much more different than you might think. Not only that nowadays the biggest companies also got a real profits, but the macro situation is different as well. For example, while back in 2000 the interest rates were at the levels above 6% with the growing trend, currently the interest rates are at the much lower levels, and also we are in the decreasing trend, while the interest rates are also expected to go lower in the following months. Next metric we can take a look at is the enterprise value divided by EBITDA. This one is good for showing whether the profits justify the valuations. Here we can see that already in the 2020 we were at the levels of the top of the dot-com bubble. And when we will take a look on the current levels of the enterprise value divided by the EBITDA, we can see that we are sitting at the levels of about 22.86 for total markets, or the levels of 18.53 for the total markets without the financials, what in both cases is much higher than we were at the top of the dot-com bubble. So as per this metric, we are not only most expensive since the dot-com bubble, these stocks are currently most expensive in the history. On the other side, when we'll take a look on the SP 500 compared to its earnings, we can see that earnings are still above the SP 500 line. What is good, of course, but we could see few times in the past, in the 2009 financial crisis, in the 2000 dot-com bubble, and also during the 2020 COVID crash, that the EPS, what is the earnings per share, dropped below the SP 500 price line. But between those periods, so between those crises, the EPS was still able to be quite high above the SP 500 line, while currently the situation quite changed and the SP 500 is now almost touching the current EPS levels. So in case the EPS will not continue in the rapid growth in the following weeks, months, years, quarter, we might see that the SP 500 chart will actually cross the EPS chart for the first time, while not counting the crisis periods in the past 30 years. Alright, so it's true that as per some metrics, it may look like the market is overpriced at the moment and that the stocks are the most expensive in the history. But even if the SP 500 is overpriced, like, what are the other options? Like, gold is currently sitting at the all-time high. Bitcoin almost at the all-time high as well. Real estates? Price through the roof. Small caps? Yes, it's up almost 5% year to date, but when we'll take a look on the performance in the previous 5 years, we basically did not move from the place since the top of the 2021. So in the end, it's really hard to tell, but I still believe it's better to be in the market than actually not. Because there is no guarantee that even though the stocks currently looks overpriced and the most expensive in the history, that it might go even higher in the following weeks, months, years, or even decades. Who knows, maybe the current levels are the lowest levels we will see in the following years. So at least for me, I will continue with my DCA, and in case of any bigger drop, I will simply increase my positions. But yeah, in case you are still not sure what to do in current markets and you would like to diversify your portfolio a little bit, you can take a look on my video about the top 5 ETFs to cover all of your investment needs. But for me today, that's really all. So thanks for watching, have a nice day, and see you all in the next video. Goodbye.